everyone, and welcome back to our channel. This is Mitchell Hudson with American Republic Insurance Services, and today we're going to dive into a topic that could potentially impact your guaranteed interest over the next 3, 5, even potentially up to 7 years. And that topic that we're diving into is CDs and annuities. And whether or not you are new to this topic, have some experience or tons of experience, I hope you get some valuable information today. Now, as the market has changed over the last few years, and during the course of my lifetime, it's changed a ton, but over the last probably 10 years or so, CD rates haven't gotten a high interest yield. They're guaranteed from the bank, they're relatively easy to set up, and you know exactly what you're going to receive. In about 2022, CD rates drastically went up, and we saw them even get as high as close to probably 6%. Now, CD rates usually are for 6 months, a year. At the longest, we're usually seeing 2 years, and that affects what guaranteed interest rate I do receive on the length of my CD. Right now, currently, we are seeing CD rates probably at about the 5 to 5.5% for 6 months to a year. But as we're talking about planning for the next 3, 5, even 7 years, we wanted to talk to you about an additional strategy that's similar to CDs, but different. And this is multi-year guaranteed annuities, also known as MYGAs. And MYGAs typically come in terms of 3-year annuities, 5-year annuities, or 7-year annuities. And they guarantee that interest rate for 3 years, 5 years, or 7 years. Now, interest rates for CDs typically follow the Federal Reserve and whether they go up or down. And a lot of people have seen the interest rates for CDs come down this year and are projecting that they will continue to come down over the next year, 3 years especially. The difference being is when I lock my CD up for 1 year, I'm not deferring my tax. I have to pay the taxes on at the end of this year and then renegotiate for my next interest rate. With the multi-year guaranteed annuity, I am going to lock my interest rate in for 3, 5, or 7 years. And right now we're seeing them at 5.5% that you can lock in for 5 years. So if I can guarantee that 5, 5.5, even up to 6% for a 5-year term, that's a lot different than renegotiating my CD every year and watching as my rates continue to go down year after year to as low as they've been in the past at 1% as little as 3 years ago. So what are some of the big key differences between CDs and multi-year guaranteed annuities? CDs are issued by banking institutions. They are insured by the FDIC, and they usually come in terms of 6 months to 2 years. Now, multi-year guaranteed annuities are tax deferred. They are issued by insurance companies, and they're insured by the NAIC, and generally come in terms of 3, 5, and 7 years. So another key difference, as we're talking about the true differences between multi-year guaranteed annuities and CDs, are one of the bigger ones is I can take my multi-year guaranteed annuity, I can keep rolling it into tax-deferred status. I can renew into a 3-year term again, or a 5-year term, or a 7-year, or at the end of my term, I let it go from year to year. But I can also turn it into a guaranteed revenue stream. Once I turn that option on, it pays me whatever annual or month-to-month or whatever I choose, monthly, quarterly, or annually, and it provides me a guaranteed revenue stream for the rest of my life. Now, some of the similarities of annuities, these multi-year guarantees, MYGAs, and CDs can be as simple as I'm getting a guaranteed interest rate for multiple years, that I do have some liquidity within it, but not very much, because there are rules that I can't withdraw my money from my annuity early. I'm going to pay some sort of a penalty. Those same rules apply to CDs as well, to where I cannot pull my money. I am going to have some penalty. Generally, it's just an interest penalty for the interest accrued during the time of my CD, but I do have a little bit of liquidity in either one, but not much. They're usually savings vehicles for the future. So now that we know some of the key differences and similarities between multi-year guaranteed annuities, MYGAs, and CDs, who are MIGAs generally good for? Because they probably aren't good for everyone. They're good for people that are looking to take advantage of a guaranteed interest rate for a set period of time. They're good for people that want to enjoy protection from market loss. They're good for people that want to benefit from tax deferred earnings. They are also good for people that want to have an option to settle that MIGA at the very end for a guaranteed income stream for the rest of their life. Those are the types of reasons that you would choose to put your money with a MIGA and versus maybe even a CD. So now that we know who is looking for annuities, some of the differences or most of the differences between CDs and MIGAs, the thing that we need to know is currently many different annuitant companies are offering 5-year guarantees of over 5%. That can be a huge rate of return over the next 5 years. Not a huge difference, maybe only a small amount between what my bank CD is offering right now and what that current MIGA is. But over the course of 5 years, that could make a significant difference as we see CD rates start to come back down. If you've had a CD come due recently, you know that you have one coming due in the future, are just interested in guaranteed growth safe from the market, please, I urge you to reach out to an American Republic representative in your area. If you're looking for someone in Illinois, my name is Mitchell Hudson. You can reach out direct through email at mitchell.hudson@arisagency.com. You can go to our website, AmericanRepublicInsuranceServices.com, and hit the info tab and send us a direct email so we can reach right out to you. But I want to thank you again for your time, and we really appreciate you listening and watching. Have a great day.